You could say that the difference between assets and liabilities is pretty straightforward. Assets are items that bring money into your pocket, while liabilities are those that take money out. The goal, of course, is to increase your assets and minimize your liabilities. In this video, we'll dive deeper into understanding these two terms and how you can effectively manage them to improve your financial health. First off, let's clarify what assets and liabilities are. An asset is anything you own that has the potential to produce income or increase in value. This includes investments, real estate, stocks, or even intellectual property. Essentially, if it can generate money, it's an asset. On the flip side, liabilities are obligations that drain your resources. Common examples are loans, debts, and any other financial obligations that diminish your wealth. We'll break down some everyday examples to illustrate these concepts further. Take a house, for example. Many people consider their home an asset. However, unless you're earning rental income or planning to sell it for a profit, a house may act more like a liability. This is especially considering mortgage payments and maintenance costs. Remember, these are long-term payments that you have to contend with, often for 20 or even 30 years. Contrast that with investment properties or stocks that potentially bring in regular income or appreciate over time, qualifying them as assets. An investment property in this case is real estate that you're planning to sell for a profit in the future, earning rental income in the meantime. More about that later in this video. Now, what about a car? Most cars depreciate quickly, meaning they lose value the moment you drive them off the lot. It's even worse with luxury cars, which can lose up to half their initial value in the first few years. So unless you're dealing with specific classic or collectible vehicles, a car is typically a depreciating asset or even a liability, considering the associated costs of maintenance, insurance, and depreciation. However, if the car is essential for income-generating activities, its role becomes a bit more nuanced. But for many people, cars are simply liabilities, since they consume a surprising amount of money. Of course, you can sell them later to recoup some money, but don't forget about those costs you've incurred in the meantime. According to the AAA, the average cost of owning a car in the US is more than $12,000 a year. So unless your car is generating more cash than it's consuming, it's a cash drain. Understanding the distinction between tangible and intangible assets is also key. Tangible assets are physical. They're things you can actually touch, like buildings, land, or machinery. Intangible assets, however, are not physical. These include things like patents, trademarks, or copyrights, or brand value. Both types hold value, but in different ways, and both have their pros and cons. Let's talk a little more about the distinction between real assets and financial assets. Real assets like land, gold, or oil have inherent value. This means they are valuable due to their physical properties and utility. For example, land can be used for farming, housing, or business premises. Commodities like gold or oil have uses in industries or as investments themselves. Their value doesn't just disappear simply because they are tangible and have a use in the real world. On the other hand, financial assets such as stocks, bonds, or derivatives are a bit different. Their value isn't in the paper they're printed on or the digital code they're represented by. Instead, it comes from what they represent: a share in a company's earnings, a creditor relationship with a borrower, or future cash flows. The market dictates their value based on various factors like company performance, economic conditions, and investor sentiment. So, a stock's price, for example, reflects the collective valuation of all market participants. This can fluctuate wildly based on news, trends, and economic indicators, often unrelated to the physical or functional value of the underlying company. Understanding these differences is crucial. While real assets provide a tangible hedge against economic shifts, financial assets offer higher liquidity and potential for growth, albeit with some higher risk and volatility. Balancing these in your portfolio is key to a robust financial strategy. Each type of asset has its place, and savvy investors understand how to leverage the advantages of both to build wealth and stability. Now, let's dive into some specific asset types, starting with stocks. When you buy stocks or shares, you're essentially buying a piece of a company. Think of it as owning a slice of the pie. The size of your slice depends on the number of shares you purchase. Owning stock means you're part of the company's journey, sharing in its profits and sometimes its losses. The first way to profit from stocks is through capital gains. This is when you sell your stock for more than you paid for it. The stock market is driven by supply and demand, and various factors, including company performance, industry changes, and economic conditions, can affect stock prices. If you sell your shares when they're worth more than you paid, the difference is your capital gain. It's a popular strategy, but remember, the market can be unpredictable, and prices don't always go up. The second way to profit is through dividends. These are payments made to shareholders out of the company's profits. Not all companies pay dividends, but those that do typically distribute them quarterly. The amount you receive depends on how many shares you own and the company's dividend rate. Dividends can provide a steady income stream, and when reinvested, they can significantly boost the value of your investment over time. Investing in stocks requires research and a level of risk tolerance, as the market can fluctuate. But for many, the potential for growth and income makes stocks a cornerstone asset in their financial portfolio. Informed decisions and a clear understanding of your financial goals are key to navigating the world of stocks successfully. Real estate is another common asset, spanning from homes where families live to office buildings where companies operate. The magic of real estate as an asset lies in its potential to create ongoing income or grow in value over time. For instance, rental properties can provide a steady stream of income, turning them into a reliable asset. The U.S. Census Bureau noted a median asking rent of almost $1,500 in 2023 for vacant rental units in the U.S., highlighting the potential earnings from rental real estate. Of course, this will vary by city and neighborhood. Alternatively, strategic selling after appreciation, which is buying a property and selling it when its value increases, can yield significant returns. The key is in smart acquisition, understanding market trends, and sometimes making improvements to the property to enhance its value or appeal to renters or buyers. Whether it's through generating rental income or selling at an appreciated value, real estate can be a powerful asset in your financial portfolio. But not everyone has the capital or expertise to jump straight into property investment. That's where real estate investment trusts, or REITs, come in. REITs allow you to invest in real estate indirectly, offering a more accessible entry point for many investors. Essentially, these are companies that typically own, run, or provide funding for income-generating real estate across a range of sectors. By purchasing shares of a REIT, you're investing in a portfolio of real estate assets, similar to how you'd invest in stocks to own a part of various businesses. Moreover, REITs offer the benefits of real estate investment without the hassles of being a landlord. No fixing leaky faucets or dealing with tenants. All in, they can be a compelling, less intimidating entry point for real estate investors. Last but certainly not least, let's talk about knowledge as an asset. Your skills and expertise can be one of your most valuable assets. For example, in an increasingly digital world, expertise in digital marketing can significantly enhance a business's reach and profitability. By investing in improving your skills, whether through formal education or self-taught methods, you're effectively investing in your future earning potential. A report by the World Economic Forum in 2022 suggested that 54% of all employees will require significant reskilling and upskilling. This demonstrates the immense value and necessity of continuous learning. And unlike physical assets that can depreciate, the value you derive from your knowledge and skills can grow exponentially over time, offering you limitless potential. So by investing in your education and skills, you're not just learning. You're building an asset that no one can take away from you, your ability to generate and capture value in the marketplace. Check out more videos to help you improve your financial literacy.